What caused the 2008 financial crisis? It all started with subprime mortgages. You see, lenders started offering high-risk loans to borrowers who had poor credit histories. These individuals, known as subprime borrowers, were considered a gamble due to their less-than-stellar track record with managing debt. To make matters more precarious, these loans often came with adjustable rates. Imagine you're a borrower. One day, you're managing your loan payments just fine. Then, the rates increase, and suddenly, your monthly payment is far more than you can handle. This was the reality for countless subprime borrowers. As more and more of these risky loans were given out, it was like stacking a house of cards. Each loan was another card added to the pile. The higher the pile, the more unstable it became. And just like a house of cards, it takes only one wrong move for the whole structure to come tumbling down. As these risky loans piled up, the stage was set for a financial disaster. The crisis deepened due to two key factors: securitization and a housing bubble. Securitization was a process that saw financial institutions package risky mortgages into complex products known as mortgage-backed securities and collateralized debt obligations. This bundling technique was a double-edged sword. On one hand, it allowed for more liquidity in the market. But on the other, it obscured the true risk of these loans, leading investors to underestimate the exposure to bad loans. Simultaneously, the housing bubble was inflating. Home prices were soaring, fueled by speculative buying. This created a precarious situation where many homeowners found themselves in a financial quagmire. They owed more on their mortgages than what their homes were actually worth. This phenomenon, known as underwater mortgages, was a ticking time bomb. With a housing market teetering on the edge, another element added fuel to the fire: credit default swaps. Credit default swaps, initially designed to hedge against risk, ended up fanning the flames of the crisis. Now let's break this down. Credit default swaps, or CDS, are essentially insurance policies. They were initially created to provide a safety net for investors in the event of a default on mortgage-backed securities. However, during the build-up to the 2008 financial collapse, these financial instruments took on a whole new role. Rather than being used as a safety net, they were increasingly used for speculative purposes. This misuse was largely due to a lack of regulation. Without clear rules in place, the CDS market grew unchecked, and the risks associated were grossly underestimated. When the housing bubble burst and the number of defaults on mortgage-backed securities skyrocketed, the CDS market couldn't bear the weight. This resulted in catastrophic losses for investors and financial institutions across the globe. The misuse of these instruments was a key factor that led to the financial meltdown. In the aftermath of the crisis, significant laws and reforms were enacted to prevent a similar event. One of the most notable pieces of legislation was the Dodd-Frank Wall Street Reform and Consumer Protection Act. This law introduced comprehensive financial reforms aimed at preventing another financial meltdown. It established the Consumer Financial Protection Bureau, or CFPB for short, as a watchdog organization to oversee consumer financial products and practices. In addition, the Dodd-Frank Act enforced stricter regulations on financial institutions to increase transparency and accountability. Another significant piece of legislation was the Homeowner Bill of Rights, which was implemented in some states. This legislation provides vital protections for homeowners facing foreclosure. Measures include requiring lenders to offer loan modifications and prohibiting dual tracking, which is the practice of simultaneously pursuing foreclosure while negotiating loan modifications. Adherence to these laws is crucial, and penalties for non-compliance can be severe. Under the Dodd-Frank Act, lenders must comply with stricter underwriting standards, provide accurate information to borrowers, and avoid risky lending practices. Failure to comply may result in fines, lawsuits, and sanctions from regulatory agencies. As for mortgage applicants, they must provide accurate financial information, understand loan terms, and avoid fraudulent practices. False information or fraudulent activities can lead to serious legal consequences, including civil and criminal penalties. The Homeowner Bill of Rights also has clear rules and penalties. Lenders who fail to follow these rules, such as proceeding with foreclosure while simultaneously working on loan modifications, can face legal action, fines, and penalties imposed by state regulators. Meanwhile, mortgage applicants and homeowners have the right to receive accurate information regarding foreclosure proceedings and options to avoid foreclosure. If lenders violate these rights, homeowners can take legal action or seek damages. In a nutshell, these laws and reforms were designed to create a more transparent and responsible financial system. They aim to enhance oversight, improve risk management, and protect consumers and the financial system from the types of practices that led to the 2008 crisis.